In a business presentation, you must present financial projections or forecasts. This generally includes what your revenue and cost assumptions are. Basically, what you believe the revenue will be and what you believe the cost will be with regard to that revenue. So costs are normally a combination of fixed and variable costs. So variable costs will be presented generally as a percentage of revenue. And because of the unique nature of startup ventures, they are growth based. There generally isn't going to be profits. There will just simply be an increase in revenue as the company grows. Generally, there's going to be losses time over time. That is the reason that businesses are interested in the startup, because it is able to use all of the capital it has on hand to grow, and it needs additional capital to grow. And that growth, every dollar invested in growth presents more value in terms of growth than that dollar. Sometimes 10, 20, 30, 40, 50, 100 times the value of $1 is the value of that growth that it generates. And that's what an investor wants to invest in. So you're going to, once again, state the revenue and cost assumptions, and you'll state whatever the revenue has been over the past year and what losses have incurred. So it'll show, once again, what type of growth you've generated from the revenue on hand. And revenue is just one piece of it, because if you've incurred losses, you've spent in addition to revenue. So the revenue plus losses, that's just the entire spend that you have there, and you can show the growth in comparison to the spend. And so going forward, you will also project your spending and the growth that you will generate from it. So it'll show revenue, and then it'll show growth from that revenue. You will also probably have a line there that shows costs. So basically, these costs show capital requirements. The cost will generally be in excess of the revenue. So that's the money from investors, how it's going to be used to make up the shortfall between what you bring in revenue and what you're spending. So you'll have what's called a burn rate. That is showing how quickly your spend is. So is increasing, and how that spend relates to growth. And from there, you can show the capital requirements that you'll need to get through that growth phase. And generally, those capital requirements is the money you're asking for from investors. So really, there's three lines you're showing there. You're showing your revenue, you're showing your costs, and then you're showing your growth rate. Because once again, growth is going to be compared to your total spend, which is the combination of revenue and investor capital necessary to meet your cost requirements.